Hello.
How are you, Angela? Happy New Year.
Happy January 97th
Yeah,
also.
wow. Isn't that something?
This is dark, gloomy month ever.
Oh my gosh. It's just rain. It's just, I feel like who needs to even put on clothes? You keep a towel with you all the time.
That is great.
Oh man. So we had some new tax information today, right?
Super exciting.
Yesterday, I guess it was. I mean, that's the one good thing from this deluge we're living through right now.
Yeah. I mean, this was not even on my radar as something they would do. And the IRS said, if you are a resident of one of 31 of the 58 California counties that has declared a state of emergency
So far,
yeah,
right.
Due to the storms, you do not have to file your income tax return, pay your taxes, or make your retirement plan contributions until May 15th. Unfortunately, Contra Costa, Alameda,
we're not there.
Not on that list yet. But pay attention because we might end up on the list and we will get the extension as well. Notably, California for your state tax has not come out with the same extension yet. So we suspect they will. It would be very odd to force you to file your California return without your federal return. However, it's not law yet. So just pay attention if you're in these affected counties and you're thinking of delaying your tax return. But yay.
But I mean, if you could leave your money in, not pay your January estimated tax payment until May.
Yeah.
That's, if you're getting 4.5% on your money markets now, which most people should be, if you're not,
go watch our cash management
podcast 28, whatever it was, but that's a lot of money you could be making on that.
Yeah.
Don't give the government anything extra if you don't need to, right? That's I guess we'll be audited tomorrow now.
No, there's no one working at the IRS. Don't worry about
that. That's right. We don't have to worry about that. Yeah. And the Republicans are going to take good care of us for that, right? So don't worry. Yeah. So welcome to A Place of Possibility. We are happy to have you with us. I am Richard Del Monte.
I'm Angela Wright.
Thank you for being here. So what are we talking about today, boss?
Okay, we are talking about financial tools and strategies that seem illegal, but aren't.
That sounds really fun.
We're breaking down the top 10 investment and financial and tax loopholes to help you get the most out of your money and beat the financial and tax system. I think we should dive right in. What's the first one?
Okay. So something that sounds illegal but isn't is hiring your kid.
Okay.
Or your kids, right? So a person, a self-employed person that owns either a sole proprietorship, a partnership, or an LLC that's taxed as a partnership can hire their family members. So it could be your kids, even underage kids down to like 5 years old, or your spouse, your domestic partner, or your parents. And you don't have to pay any employment taxes for them. So like there's no Social Security tax, no Medicare tax, no unemployment tax, no state disability payment, none of that. And if it's your children under a certain age, they can make $12,950 tax free. So basically you can pay your children tax free up to $12,950 and it's deductible to you. How about that?
Come on. What's the catch?
The catch is, you have to be a certain kind of employer. You have to be a partnership or a sole proprietor. And they have to provide valuable services. So you can't just give them money. They have to provide something.
Okay. But let's say I'm I have a photography business. I'm a sole proprietor and my child models for my website.
Done.
Amazing.
Yeah. How much are you going to pay him? You can't pay him $70,000, but
I'm going to pay him $12,950. That seems like a reasonable modeling fee.
Your kid maybe 20. Maybe worth. Yeah. But
thanks.
But yeah, that totally works.
Wow.
Yeah.
That does sound illegal.
Yeah, you're right, but it's not.
Amazing.
So what's next?
Speaking of tax-free income, did you know that if your adjusted gross income is less than $116,000 a year, you pay zero federal capital gains tax?
Do tell.
Zero. Okay. So I've got two examples of how you could use this to your benefit. The first one is for a younger person, but an adult. This is often the period of your career where you're just starting out and you're not making gobs of money yet. So being under 116,000, especially on the national average, is pretty reasonable. Yeah. Just got out of college, right?
Sure, of course.
So let's say I'm a parent and I'm about to gift my daughter, $50,000 to buy her first house. Normally I would go over to my trust. I'd sell off some Apple stock. I would, and then cut her a check. But remember, my daughter makes less than $116,000 a year. So instead, what I'm going to do is gift her the shares of the appreciated Apple stock.
Without selling. Okay.
Yes. She's going to sell the Apple stock. And guess what? She only makes $50,000 a year. So even if that stock was 100% gain, she would pay zero capital gains tax on that transaction.
That sounds too good to be true.
I know. Okay, so the other end of the spectrum.
There's more?
Oh, yeah, baby.
Oh, my gosh.
This gets good.
Wow.
So on the other end of the spectrum, we often see retirees who have managed to whittle their income down, for tax purposes. And so just yesterday, we were with a couple who their AGI is about $100,000 a year. That's their Social Security and their pension payments. And they wanted to work on their house. And so they were going to pull some additional funds from their IRA, like $15,000 or so.
Right.
And they were going to go ahead and pay ordinary income tax on that.
Makes sense. Yeah.
But they also have a trust account that they've had forever with a lot of appreciated mutual funds and exchange traded funds in it. Okay. Mm-hmm. Right. Mm-hmm. So what we did was we found a fund that gives them the amount of money they need with only a $15,000 capital gain. Guess how much tax they paid on that distribution?
Zero?
It's zero. We got their income right to $115,000 AGI and they paid nothing. They were going to pay ordinary income tax on that distribution.
So that sounds like it should be illegal.
You're right, but it isn't. What's next?
Wow. Well, let's say that you are self-employed and you're making a pretty good, we'll call it gobs of money.
Okay.
And most CPAs would tell you to open up a SEP, a Simplified Employee Pension Plan. I don't know what it is about SEPs. Do they get paid by the SEP industry or something? Why do they only go with SEPs?
Well, they were the gold standard for a really long time. We had no other option.
That's old school
like 20
CPAs.
Years.
Anyway.
I know.
So they would tell you to put money in a SEP. And basically you can put in 25% of your net income from your business into a SEP. So, up to $66,000. That's the cap for this year. But that's nice. But what if you made $400,000 or something like that, a really good high income? Well, you could open up a solo 401k. So you basically have a 401k company, a fund just for your company alone, one person or you and your spouse. And then just like your neighbor who works at a big company, Apple or whatever, you can put in up to $22,500 as a salary reduction contribution for yourself. And if you're over 50, that goes up to $30,000 this year. But wait, there's more. You can also put in 25% of your company income on top of that. So you can go all the way up to $88,500 in your solo 401k this year, instead of a maximum of $66,000 in the SEP.
But hold on, if I have a 401k, I've got a TPA, I've got a tax return, it's expensive. I don't deal with that.
Not with this. If you go to like a Vanguard, Schwab, Fidelity, the kind of thing, you can have up to $250,000 in assets in your solo K. No third-party administrator, no cost, no tax returns, extra returns, none of that stuff. You're exempt from that.
Come on.
No, it's true.
That should be illegal.
You're right, but it's not.
Amazing.
What's next?
Do you make too much money to contribute to a Roth IRA? The tax code prohibits contributions to your Roth IRA if your income is more than $153,000 for a single filer and $228,000 for joint filers. No problem. There's a loophole for that. It's called the backdoor Roth. I'm going to teach you how to do it right now.
Do I dare ask? Okay.
Here we go. So first step. Make sure you have no other existing IRAs out there. Rollover IRAs from an old 401k, contributory IRAs that you deducted, 100 years ago when you didn't have any income, SEP IRAs that your CPA made you set up for your business, anything like that. You cannot do a backdoor Roth contribution tax-free if you have other IRA money. Don't worry, I got a way around that. If you have IRAs and you're currently working, roll them into your current 401k, 403b, or 457 plan. Or if you're self-employed, start a solo 401k and roll it in there. Boom, you have no more IRAs. You're ready for step 2.
Okay.
Step 2 is you're going to open a contributory IRA and you're going to make a contribution for as much as you like up to the max. So it's $6,500 for under 50, $7,500 for over 50. You make the contribution to your IRA and you do not deduct it. The next day, after that, transaction clears, you simply transfer it on over to your Roth IRA, and then you go ahead and invest that money. And you have just effectively made a Roth IRA contribution with no tax consequence, and you've skirted around the income limits for Roth IRAs.
So basically, IRS, you're not the boss of me. Is that what you're saying?
Yes, exactly. Voila, you've beat the system.
So that sounds like it really should be illegal.
You're right, but it isn't.
Wow.
Okay, tell me the next one.
Okay, so
Roth IRAs for dependent kids.
Let me see. Do I have it on the wrong one?
Yep.
Okay. All right. Here's a tax hack. Did I get out of whack?
You did. You went out of
whack. I ruined the whole show, folks.
You're fired. Okay.
Here's another tax hack for folks that have dependent children. So let's say your kids have earned income, and like you said, they can earn up to $12,950 tax free. And then they can also put money into a Roth IRA for themselves, up to $6,500 a year.
A minor can have a Roth IRA?
A minor can have a Roth IRA. And here's the killer part. So there's no tax anyway. They have zero taxable income. So they just put the money in a Roth. And then if they put in like $6,500 a year for just 5 years as a young kid, by the time they are retirement age, they will have more than 3.6 million with a capital M dollars in their Roth account. And it's tax-free when it comes out. Now, I'm sorry. That should be a mic drop. Right there, right?
That is a mic drop moment.
That's crazy,
what?
Right? That is insane. That's right.
Tax-free, $3.6 million.
Right. Nobody paid any tax.
Years.
You deducted it. Your kid paid no tax. Put the money in the Roth. Turns into $3.5 million, no tax.
Okay, seriously, that does sound illegal.
I know it should be, but it's not.
Amazing.
What's next?
It is time for our moment of possibility, where we tell you about a real client with a real challenge and how we solved it. Names, of course, always change to protect the innocent. This week, we're talking about Dennis and Melissa. They have a 14-year-old daughter. Dennis is 8 years older than Melissa and will reach full retirement age for Social Security purposes in 2 years. So what happened? So
we were looking at his situation, and we most people have no idea. Maybe you don't know. We sure do that children under age 18 or that haven't got out of high school yet can also get Social Security benefits if their parents are on it.
Mm-hmm.
Right?
That's awesome.
So there was an advantage for him, because normally we tell people wait till 70, but if he started taking his benefits right away, he would get an extra like $2,200 a month for the child, to pay for the child until they were 18, and the kid was like 13 or 14. Mm-hmm. So what ends up happening is if he takes Social Security now, he'll get a lower amount than if he waited till 70, but his kid will get her entire college, expenses paid for by Social Security.
Wow.
So all that money he had set aside for that goes into his retirement. All of a sudden, everything, there's a lot of healing going on.
Oh my gosh.
Yeah. So it was amazing. And if you look at what they were going to be able to be collecting over their lifetimes, it was going to be way more money for both he and his wife.
That's
pretty amazing.
Incredible.
So you got it again. It just goes back to, the value of doing really good planning and knowing what you're doing.
Mm-hmm. Yeah. That was a good one.
Yeah. Right. Yeah. But I bet we could probably just manage our own money by ourselves. We don't need an advisor, right? Yeah, right. Okay. You should do your own heart surgery as well. I'm telling you. Okay. So what's next?
Okay. Do you think that you can only put $22,500 into your 401k at work?
Most people do.
That's think kind of again.
Limit, right? There's more.
Yeah. Yeah. So many plans have a provision allowing you to super fund your 401k by adding an additional $43,500 of after-tax contributions, which is separate from the $22,500 employee deferral.
It's already sounding illegal.
Which that deferral, it's your choice whether you do that pre-tax or if you do Roth 401k, right? So actually, you can put a total of $66,000 into your employer-sponsored 401k, right? Now, there's an asterisk. This includes your employer match or profit sharing.
Okay.
So how do you figure this out? Well, first you take your employee deferral of $22,500. Add to that anything that your employer is putting in for you. So let's say, your employer's giving you
$5,000 match or something.
Sure. Yeah. Okay. You add those things together, then you subtract that number from 66,000, and that's the amount that you can super fund your 401k with after-tax contributions.
Well, that sounds pretty amazing.
It is.
But then what happens?
But wait, let me have my Billy Mays moment. There is more.
Okay.
You can take that after-tax contribution and you can immediately convert it into Roth money.
Oh, get out. Seriously?
Okay. Yes.
Wow.
So let's say your employer gives you nothing. You
As a match, you mean?
Yeah, let's say you put in 22.5. You could put 43,500 a year into a Roth IRA and never pay a dime of taxes on any of those earnings.
Gosh. Plus, you could do a Roth IRA on top of that, right?
Yes,
if you wanted
you could do your
if you qualified.
6,500.
Or the backdoor.
Yes.
Now, come on. That really sounds like it should be illegal.
I know, but it isn't.
Wow. That's amazing.
What's next?
Okay. Do you want to help your child build their credit history before they are turning 18? So
Do I?
Yes, you do. Sure you do. You want them to have a really good start. So parents can actually open up a secure credit card in the name of the child. And you can just basically, it's not a credit card. It's a debit card from the bank, right? But it creates credit for the kid.
How does it work?
You put in money, you fund it, and the kid can go spend it. And then as long the kid can only spend it until there's money that runs out of money, and then you refund it again. You just keep that thing in play until they turn 18, and all of a sudden they're going to have 18 years worth of credit history.
So I'm off to college. I can go get my own apartment without a cosigner.
Right, but right. Parents don't have to co-sign
for the
my
drunken
parents
neighbor. Co-signing my apartment when I college.
For the drunken roommate that doesn't ruin something, you're off the hook as a parent. Smart planning.
18-year-olds out there walking around with a full credit history.
Or they can buy a car. I mean, some of it could be a little dangerous, right?
Sure.
Because they could go buy stuff, but that's where it's on you to train them.
Whew.
But the caveat is you can only do it with certain banks. So Citibank, B of A, Chase, not Wells. Wells doesn't allow
the
them.
banks have slowly been getting rid of these because, frankly, they don't make any money on them.
Yeah.
There's no interest charges, right? They get nothing out of this.
Right.
So,
right.
Man, but that does sound illegal to give a child a credit card.
You're right, but it's not. What's next?
Let's say we want to help an adult build their credit history. One little thing that you can do is add them as an authorized signer on a credit card that you've had for a long time that has a really good history. After this person has been an authorized user on your card for 30 days, the entire credit history of the card transfers to them.
Oh my gosh, you gotta be kidding me.
If it's a good history, it bumps their credit score. It also helps their saturation rate if the card isn't maxed out all the time because they have more available credit.
So if they're 18, they get a 30-year credit history?
They could.
Wow, that's pretty crazy.
And it will bump their score.
Wow, that should be illegal.
I know, but it isn't. What's number 9?
All right. Got losses in your crypto?
Who doesn't?
Who doesn't, right? That you want to realize, but you don't want to be out for 30 days. Okay, if you don't want to be out of crypto for 30 days, I don't know what to tell you. But guess what? You have to be, when you sell something like a capital asset, like a stock or something, you have to be out of it for 30 days. Otherwise, you suffer what's called the wash sale rule. You don't get to take the tax loss. So crypto, though, isn't stock. It's actually just property. We've been
saying this for years.
Right. It's just property. So it's not subject to the wash sale rule. So you can basically sell it. And if you're really stupid, you could buy it back the next day.
He doesn't mean
that. Yes, I do, actually. You can buy it back the next day, and you can lock in the capital loss still. You can lock in the loss. But the little asterisk for that is it doesn't apply to crypto ETFs or crypto mutual funds, which are soon to go out of business.
So you don't worry about it anyway.
Yeah, right. So, but
I think also this loophole was on the chopping block when
very true.
The Build Back Better Act, which never passed, but I suspect this loophole will be closed eventually.
Probably, right. But there's still the carried interest rule is still going strong, so who knows? But I think the constituency for crypto is slowly or maybe quickly dwindling because they're all bankrupt or in jail. So anyway. Okay.
It does sound illegal.
It does, but it's not.
Sounds illegal.
But it's not. Owning crypto should be illegal, but it's not.
At least not. I think truly you should be an accredited investor to get into crypto.
You really should, yeah, because people have lost a fortune.
Although some would argue that's gatekeeping. Really good.
Yeah, protecting from themselves. Yeah.
We don't have strong opinions about this.
No, not at all. Okay.
Number
what's
10.
next? The last one, right?
The last loophole. Okay. We've all heard, I think, of health savings accounts. Your employer sets this thing up for you if you have a high deductible health plan. You'll see something on your plan like HDHP.
Yep.
Okay.
Yep.
And the cool thing about it is you get to deduct the money that you put into your HSA. And it's treated like Roth money on the back end. You never pay a dime of taxes on any earnings in that account. So, and you can invest it. You could get interest if you go fixed income, savings account, or you could invest that money in your HSA. And if you use it for qualifying medical expenses, you never pay a dime of tax on any of that growth. So it's like the best tax treatment of any asset in the world. Okay. If you're under 65, it has to be used for medical expenses. If you're over 65, you can use it for other things, but you have to pay income tax on your contributions. Okay. So this is really awesome, but there are so many of us out there that do not have the HDHP letters written into their health plan. Ready for the loophole?
Let's have it.
So according to the IRS, you technically have a high deductible health plan if the deductible is at least $1,500 for a single, $3,000 for a family, and your out-of-pocket max is $15,000. So even though your employer doesn't offer this, you technically have a high deductible health plan, and you can go set up your own HSA account separate from your employer, and you can fund that sucker with $38.50 for 2023 if you're single, $77.50 if you have a family, and if you're over 55, you get an extra $1,000 in that account. You can do it anyway.
That's
and then you go on over, I like Lively. You go on over to Lively, you start your HSA, you put in the max, and then you hook it up to a custodian like Charles Schwab or Fidelity, and then you invest that money. And I'll tell you, if you start this at a younger age, all of your retirement medical expenses will be paid for and tax-free.
Right. And if you're over 50 years old, you can use it for prior year expenses, right? So you just save them up. And just, like if you don't spend the money, but later on, if you need money for something else, you can go, oh, I have these expenses for medical expenses from a few years ago that I've been saving, and I can use it for that.
Isn't that amazing?
It's amazing, right? So if you own crypto and you were in the insane asylum for a period of time, you could use it to pay yourself back for that. So remember that.
Okay, so
that should be illegal.
It does sound illegal. That loophole is what?
Yeah.
So you got to get right with your CPA. We talk to a lot of them, and many of them follow the letter, of the law that says it has to be sponsored by your employer. But there are also many CPAs out there who are willing to go to bat for you and say, nope, this is the IRS definition. You meet it. You're good to go. So if you're just saying no, find one that says yes.
Yeah, that's really true.
Yeah.
It's really true.
Right.
We have a question from our audience. So is there anything I can do? I have a 529 plan that's got money in it, and I don't have any more kids that go into college. Is there anything I can do with that? Like roll it over someplace?
There sure is.
Actually, yeah. What can we do, Angela?
There was a recent, what the heck was the act called? I'm blanking on it.
Oh,
was it Secure 2.0?
What is it? The
Inflation Reduction Act.
Yeah.
One of the most recent.
No. It's Secure Act 2.0.
That was passed right on
We're getting confused
New Year's
with all
Eve
the tax
or something.
laws. Yeah. Right.
Okay, so the point is you can convert your 529 to a Roth IRA now.
Get out.
That should be illegal. Just kidding.
That should be, yeah.
Isn't that cool? But there are some caveats there. You can only do, $35,000 total.
In your lifetime.
Or the Roth IRA contribution limit each year, up to $35,000 in your lifetime.
Right.
Is that right?
So if it's $6,500, you can put that in, right?
Yep. For however many years to get you to 35.
Right.
It's the only asterisk, right?
You can only, if you already put in $6,500 in your Roth, you can't put anything.
Oh,
in.
you can't double up.
Right. There's a little question mark still about this. We don't know the answer yet, and we're waiting to hear. But because you can change the owners of 529s to different people. So one spouse could do 35,000 in theirs, switch it to their spouse, and they could do 35,000 in theirs. Maybe your kid could do it. We don't know if that's going to be the case.
Always finding those loopholes.
Yeah. One caveat. Another caveat is though you have to have had the money in the 529 for 15 years to be able to roll it over. So there's some caveats. We're gonna have to wait and see how that all shakes out. But potentially, a family, if they keep moving this around, passing this thing around like the old maid in the family, they could end up getting out the whole thing tax-free into Roths, which would be pretty amazing. Wow. Or they could save it and use it for another family member, right? Grandkids.
Yeah, we
nieces,
had an
nephews,
interesting scenario with a child of they're an adult now, offspring of a client. And I believe they're like 35 years old and they've got like 50,000 in their 401 or their 529 that they never used. And we're chatting and they're saying, yeah, we want to have kids someday. And we think, oh my gosh, we do the math. And we say, if you had a kid this year and you just left that 529 invested for the next 18 years, you never have to save a dime for your own kid's college.
Pretty amazing.
How awesome is that? Amazing. So that's one way but then, with this client, we looked at, does it make more sense for them to start converting to Roth?
Yeah.
In this case, no, because they do backdoor Roth contributions and they're working.
Yeah. But more than likely the Roth makes more sense for sure, right?
Yeah. So at any rate, there you have it. Our top 10, and you got a bonus loophole on the 529 to Roth. We really hope you enjoyed today's show. Like and subscribe wherever you get your podcasts. If you have any questions, please write to us at info@aplaceofpossibility. We also love to know what topics you want us to talk about. So don't be shy.
For sure. Yeah.
If you'd like to schedule a consultation with Richard or myself, you can click on the link in the show notes to book an appointment with us. You can also request a copy of our latest ebook, The Investment Answer. If you want to know more about how we do the investing that we do, this is a really accessible and quick read for most people. And we think you'd enjoy it. So please let us know if you want a copy of that.
Yep. So we hope you had a wonderful holiday season with your families. We're all glad it's over. Start going on diets now and using our HSAs to pay for that. And remember, until next time, you're invested and so are we. Thanks a lot, and we'll see you again soon.